So now that we've covered the basics of how options work and how you could potentially profit from them as a buyer or a seller, let's dive into one strategy in particular, covered calls. The covered call is a common starting point for new options traders because it combines call options with stocks you already own. So what is it? Generally, the goal of a covered call is to generate income by selling out of the money calls on stock you already own. As the option seller, you hope the option decreases in value so you can buy it back for less or let it expire worthless. So you get to keep the premium and the shares of the stock. But remember, as the option seller, there's the possibility of getting assigned and being obligated to sell the stock. The stock you own can limit risk and serve as collateral. If you get assigned, the stock will automatically be sold to fulfill your obligation. Because of that assignment risk, don't consider this strategy unless you be okay with selling those shares of stock if the trade doesn't go your way. In fact, some traders use covered calls as a way of exiting a stock position they already plan to sell because it can earn extra income along the way, thanks to the option premium. But for now, we're going to focus on using a covered call as an income generating strategy, selling contracts we hope expire worthless. Let's look at an example. Suppose a trader holds 100 shares of stock XYZ, which she bought at $46 a share. Let's say she sold a call with a strike at $48 that expires in 30 days. She earned $100 in premium on the trade. Since she bought the shares at 46, the break-even point is 45. 46 minus $1 for the premium. If the stock falls anywhere from $46 to $45, the premium will offset the losses and the trade would still be profitable. But if the stock drops lower than 45, she would start to lose money. Let's say the stock goes up to $49 a share at expiration. The option would be in the money, and there's a good chance it would be exercised. That means she would be forced to sell those 100 shares. She'd keep all of the premium, $100, and the profit from the stock sale at the strike price. Remember, she agreed to sell the stock at $48, which is $2 above where she bought it at $46. That's another $200 in profit for a total of $300 gain. One thing to keep in mind is that there's a risk of missing out on further gains if the stock goes up even further. And what if the stock only goes to 47 at expiration? In this case, the option is out of the money and would expire worthless. Why would another trader buy the stock at 48 when they could buy them at 47 on the open market? In this case, she'd keep the full $100 of premium plus $100 worth of price appreciation on the stock she still owns, for a total profit of $200 minus any fees. So now that you've seen how covered calls work, let's break down how you actually trade them. Trading a covered call comes down to a few key decisions. First, choose an underlying. Some stocks may be better suited for covered calls than others. Next, choose an options contract. This has two parts. One, choosing an expiration, or how long the option will last. And two, choosing a strike price. Once you've chosen a contract, you need to determine your position size. How many contracts will you sell? This depends on how many shares you own or how many you would be willing to sell if you get assigned.